In this video for chapter 8 sources of business finance, we will be discussing 4 sources of business finance, that is retained earnings, trade credit, factoring and lease finance. First one to discuss is retained earnings. When companies earn profit, the profit is distributed among the shareholders as dividend. Most of the time, the companies do not distribute all its earning among the shareholders. Those profits are retained in the business for future use. That is known as retained earnings. Retained earnings are source of internal financing or self-financing. We can call it as plowing back of profits. It forms the parts of owner's fund because the profits belong to the owners, and since it is not distributed to them, it will increase the owner's fund. Retained earnings are permanent source of funds to the organization, and no explicit cost is there like issuing of shares or taking loans from bank, issuing debentures have certain cost to them. But in case of retained earnings, there is no such explicit cost in the form of interest, dividend or flotation cost. Second one is trade credit. Trade credit is a source of short-term funds. It is extended by one trader to the another trader at the time of purchase of goods or services. It is a facility provided by one trader to another trader to acquire assets or services, and the payment will be paid after certain time. Such credits appears in the books as sundry creditors or accounts payable under current liabilities. Okay, trade credit is commonly a source of short-term finance, as I had already discussed. One of the advantages of trade credit is that it does not create any charge on the assets of the firm. But the drawback is that it generates only a limited source of funds. You cannot depend on trade credit for a large source of funds, okay, and for long-term sources of funds. Factoring. Factoring is a financial service provided by certain financial organizations under which they discounts the bills and collect the debts on behalf of the client. Okay, the receivables on account like trade credit, bills receivable, debtors, trade receivables are transferred to the factor, and after deducting certain discount, they pay the amount to the company. And they also provide information about the credit worthiness of the prospective clients with whom the business is going to enter into any kind of transactions, so that in future they don't face any kind of bad debts and all. Factoring also do not create any kind of charge on the assets. Sometimes when the number of debtors or receivables are more, the bill amount is less. In that case, this source become little expensive. Again, on this source you cannot depend a lot, because from this source you cannot arrange large amount of funds, and for a long period the funds cannot be arranged. The last one is lease financing. Now, lease financing is a contractual agreement whereby one party, the owner of the asset, allows another party to use the assets in return of certain periodic payments, that is we can call it as rental payments. Okay, generally such type of financing is used in kinds of assets which are very expensive, like aeroplanes, Airbus is there, or very heavy equipments are there, where the change in technology is frequent. So the one who is going to use the assets don't want to take the risk of the asset being obsolete. Okay, so in other words, we can say that lease financing is renting of an asset for some specific period. The owner of the asset is called leaser, and the party that uses the asset is known as leasee. At the end of the lease period, the assets goes back to the leaser. Okay, the ownership is not transferred here. And while taking lease financing, one should consider the cost of leasing an asset as compared to the cost of owning the same. Okay, which one is more expensive? You should keep that thing in mind. All of you go through the merits and demerits of these all four sources of financing. Okay.